Trading in the Zone by Mark Douglas. 30-minute summary. Imagine a trader poring over charts, armed with the best strategies and market analysis, yet still losing money trade after trade. What's going wrong? According to Mark Douglas, author of Trading in the Zone, the missing piece isn't more market knowledge or fancy indicators, it's the trader's mindset. In Trading in the Zone, Douglas reveals that consistent trading success is 80% psychology and only 20% strategy. In other words, even the most skilled market analysis can be undermined by fear, greed, or lack of discipline. In the next 30 minutes, we'll break down the essential concepts that can transform your trading mindset. We'll cover why psychology plays a critical role in trading performance, how to overcome fear and truly accept risk, why you must think in probabilities instead of certainties, and how to cultivate the discipline and consistency of a professional trader. Throughout the summary, we'll use clear examples, from casino analogies to real trading scenarios, to make these ideas easy to grasp. By the end, you'll understand what it means to trade in the zone, that mental state where trading feels almost effortless and losses don't shake your confidence. The critical role of trading psychology. Mindset over methods. Many traders spend years mastering fundamental and technical analysis, only to find that something still holds them back. Mark Douglas argues that psychology is the final frontier that separates consistently profitable traders from the rest. Fundamental analysis looks at economic data and technical analysis focuses on price patterns, but neither addresses the real reason traders often fail, our own mental and emotional biases. In fact, Douglas observes that roughly 95% of trading errors are caused by psychological mistakes, things like not accepting losses, getting overly attached to a position, or feeling invincible after a win. This means even a great trading strategy can be ruined by fear, hesitation, or impulsive behavior. Why mindset matters. What makes the mindset of a winning trader different? Douglas explains that successful traders think differently about risk and uncertainty. They have trained themselves to remain calm, disciplined, and confident without letting fear take over. A key insight is that the market doesn't make you fail or succeed. Your own reactions to the market do. Two traders can use the same strategy. One might panic during a drawdown and abandon the plan, while the other sticks to it unemotionally and eventually reaps the rewards. The difference lies in their mental approach. Trading in the Zone teaches that by changing our beliefs and attitudes about trading, we can change our results. Douglas himself learned this the hard way. He started trading in 1978 and lost his entire trading capital by 1981, an experience that drove him to uncover the mental barriers holding traders back. Example: imagine two traders using an identical trend-following system. After a couple of losing trades, Trader A gets anxious and skips the next signal out of fear. Of course, that next trade turns out to be a big winner, but Trader A isn't in it. Trader B, on the other hand, trusts the system and takes every valid trade, viewing the losses as just part of the game. In the end, Trader B catches the winner and profits. Both traders had the same strategy, but Trader B had the right mindset and consistency. It's not about who had the better analysis. It's about who had the better psychology. Accepting risk and letting go of fear. Fear, the trader's biggest enemy. One of the first major lessons in Trading in the Zone is that you must accept the risk of trading, truly accept it, to eliminate fear. Fear manifests in many ways for a trader. Fear of losing money, fear of being wrong, or fear of missing out. If you don't come to terms with the fact that any trade can be a loser, you'll end up hesitating, second-guessing, or panicking at the worst moments. Mark Douglas famously said, "When you have accepted the risk, you will be at peace with any outcome." In practice, this means before you enter a trade, you decide how much you're willing to lose, your predefined risk, and mentally accept that potential loss. Once you've made peace with that, there's no need for fear. Whatever happens, you'll stick to your plan without hesitation. The cost of fearful trading. Trading with fear leads to classic errors. For example, a fearful trader might exit winning trades too early at the first sign of profit, because they're afraid the market will take it away. Or they might hold on to losing trades too long, moving a stop-loss further and further, because they're afraid to accept the loss. Both behaviors can wreck your results. Cutting profits short and letting losses run is a sure path to failure. Douglas points out that the market is an uncertain environment by nature, and trying to avoid uncertainty altogether will only paralyze you. Ironically, the traders who fear losses the most often lose the most in the end, because fear prevents them from executing their strategy properly. Acceptance equals freedom. The solution is to fully accept the risk on each trade. This doesn't mean you enjoy losing, it means you recognize losses as an inevitable part of trading, so they don't scare you. Once you truly internalize this, a losing trade no longer feels like a threat or a personal failure. It's just one outcome in a probabilistic game, a small business expense. You stop trying to avoid or deny losses, and instead focus on making the right decisions without emotional interference. Douglas emphasizes developing a carefree state of mind, confident, but not euphoric, while trading. In short, being carefree means you're not stressed about the outcome of any single trade, which allows you to act without hesitation. In this state, you can calmly analyze and execute your strategy, which puts you much closer to the coveted zone. Example: think of a casino running a roulette table. The casino isn't afraid of a player winning a big bet, because it knows that over hundreds of spins it has the edge. In the same way, a trader who fully accepts risk is like the casino, unfazed by an individual loss, because they trust their edge in the long run. For instance, if you risk 1% of your account on a trade, you've pre-accepted that 1% as the cost if the trade loses. When the trade is live, you won't be consumed by fear, because you're prepared for whatever outcome. If it ends up a loss, you move on to the next trade with confidence intact, just like the casino continues to play its game. Thinking in probabilities. Embracing uncertainty. Anything can happen. If there's one mantra that Mark Douglas repeats, it's that trading is a probability game, not a certainty. No matter how much analysis you do, you can never predict the market with 100% accuracy, and that's okay. Douglas boils this down into 5 fundamental truths of trading. Anything can happen in the market. There are countless forces at play, so any outcome is possible. You don't need to know what will happen next to make money. Trading is about probabilities, not certainties. Wins and losses are randomly distributed over any given series of trades. Even a proven strategy will have unpredictable sequences of wins and losses. An edge is just a higher probability of one thing happening over another. It's not a guarantee, just a statistical tendency in your favor. Every moment in the market is unique. No two market situations are ever exactly the same, so avoid treating them as such. These truths have powerful implications. They teach you to expect the unexpected and to stop trying to control outcomes. For instance, if you truly believe anything can happen, you'll always use a stop-loss to protect yourself, because you know even the best setup could fail. If you accept that outcomes are probabilistic, you won't be shaken by a few losses in a row, because you understand that your edge will play out over time if you keep executing consistently. The casino and coin flip analogies. Douglas often uses casinos and coin flips to illustrate the power of probabilities. Imagine a coin that has a 60% chance of landing heads. You have an edge, 60% heads, but you absolutely do not know what the very next flip will be. It could easily be tails. In fact, you could get several tails in a row just by random chance. Does that mean your 60% edge is gone? Not at all. If you flip the coin enough times, about 60% of the flips will come up heads. This is exactly how a trader's edge works. You might have a strategy that wins 60% of the time, but those wins and losses will be distributed randomly. Knowing this, successful traders treat each trade like one coin flip in a series. They don't get emotionally hung up on any single outcome. Now think of a casino. The house has a statistical edge on every game. They know that over thousands of hands of blackjack or spins of the roulette wheel, that edge virtually guarantees them a profit. But they have no idea which specific hand or spin will win or lose, and they don't need to know. The casino doesn't panic when a gambler hits a jackpot, and it doesn't celebrate wildly when players lose. It's all just part of the expected probabilities. As a trader, you should approach the market like the casino. Be the house, not the gambler. Focus on executing your strategy, your edge, consistently, and let the law of large numbers work for you. No trade is a sure thing. Embracing uncertainty also means letting go of the need to be right on every trade. Many traders fall into the trap of searching for the perfect system or refusing to take a loss because they don't want to admit they were wrong. But if you accept the fundamental truths above, you know that losses are inevitable and no setup is certain. This frees you from the pressure of perfection. You don't have to be right every time. You just need to follow your plan. By thinking in probabilities, you can approach each trade objectively, without the baggage of your last win or loss. Wins and losses become simply data, not defining moments of triumph or failure. This keeps you in an optimal mindset to correctly interpret market information rather than react emotionally. Example: suppose your trading edge is a chart pattern that historically results in a profitable move 65% of the time. You identify the pattern and take the trade, but this time the market goes against you and you get stopped out, a loss. An inexperienced trader might be upset and start doubting the pattern or jump into a revenge trade. But a probabilities-focused trader will shrug it off. They know that 35% of the time, even a high-probability setup will fail. It's just one trade. They patiently wait for the next setup, confident that if they continue to execute their edge, the wins should outweigh the losses over the next dozen trades. This shift in perspective, from individual trades to the long-term series of trades, is at the heart of trading in the zone. Discipline and consistency, the trader's edge in execution. Process over outcome. Another cornerstone of trading in the zone is that consistent success comes from focusing on the process, not on individual trade outcomes. Amateur traders often ride an emotional roller coaster, feeling like a genius after one big win and then feeling crushed after the next loss. This leads to erratic decision-making. Douglas implores traders to shift their focus to executing their plan correctly, rather than obsessing over the result of any single trade. If you have a proven strategy, your edge, your job is to stick to it religiously. Over many trades, the profits will take care of themselves. But if you fixate on the outcome of each trade, you'll start breaking rules. Maybe jumping into trades that aren't part of your plan out of greed, or avoiding perfectly good setups out of fear. Ironically, the more you try to avoid losses or demand wins on every trade, the less consistent your results become, because you're no longer trading your edge consistently. Rules are your friends. Mark Douglas observed that many struggling traders actually resist creating rules or a trading plan. Why? Because having concrete rules forces you to take responsibility for your results. If you have no rules, it's easy to blame the market or bad luck when things go wrong. But successful traders do the opposite. They take full responsibility. They define their rules and follow them rigorously, knowing that this self-discipline is what produces consistent results. A solid trading plan should cover entry and exit criteria, risk management, and routines for reviewing performance. Douglas suggests that a trader without rules is like a driver without a roadmap, likely to get lost or crash. By setting rules and boundaries, you create a framework to measure your performance and keep yourself accountable. You also remove a lot of emotional noise from trading, because when your actions are guided by rules, there's less room for impulsive, emotion-driven decisions. The power of consistency. To help traders build a winning routine, Douglas outlines 7 principles of consistency. Checklist for thinking and acting like a consistently successful trader. I objectively identify my edges. Know exactly what your trading advantage or setup is. I predefine the risk of every trade. Set your stop-loss or risk amount in advance. I completely accept the risk or I am willing to let go of the trade. Don't take a trade unless you're okay with the potential loss. I act on my edges without reservation or hesitation. When your criteria are met, execute immediately, no second guessing. I pay myself as the market makes money available to me. Take profits according to your plan. Don't get greedy. I continually monitor my susceptibility to making errors. Stay self-aware and watch for emotional or discipline lapses. I understand the absolute necessity of these principles and never violate them. Know that consistency comes from unwavering adherence to your rules. Following these principles instills the discipline needed to achieve consistent results. Notice how they all reinforce a mindset of planning, accepting, and executing. There's nothing about predicting the market or being a genius. It's about consistent behavior. By acting with consistency, you eventually get consistency in your equity curve. In other words, If you approach every trade with the same careful analysis and risk management, your results will become more reliable over time. Douglas points out that when you truly trust your edge and your rules, trading can even become boring, and that's actually a sign you're doing it right, because you're no longer riding an emotional high or low each day. Self-discipline in action. It's worth noting that professional trading done right isn't a thrill-a-minute circus. In fact, consistent trading can be a bit boring, and that's a good thing. A disciplined trader isn't frantically reacting to every tick. They're patiently waiting for their well-defined setup and then methodically executing the trade. For example, one trader might have a rule to only take trades that align with the larger trend and meet specific criteria. If those conditions never materialize on a given day, they simply don't trade that day. This level of discipline prevents overtrading and ensures they only risk money when the odds are truly in their favor. Another example. A trader's plan might dictate taking partial profits at a certain level and moving the stop to break even after that. Even if they feel tempted to grab the profit early or let it all ride, they follow their plan exactly. By sticking to these routines trade after trade, the trader becomes consistent. Their performance becomes more like the steady operation of a business, rather than a gambler's roller coaster. Managing emotions, greed and overconfidence. Avoiding the greed trap. If fear is one enemy of traders, greed is the other, and it can be just as dangerous. Greed often shows up as holding out for more when you should be taking a profit, or over-leveraging because you're blinded by the potential reward. For example, you might have a plan to take profit at a certain level, but greed whispers, "Let's wait, we can get more out of this." Then the trade reverses and your unrealized profit evaporates. Douglas notes that becoming fixated on the money can trigger greed and lead you to break your rules. The solution is to stay process-focused, follow your predefined profit targets or trailing stops, and treat each trade as just one of many. Remember, the goal is consistent results, not hitting a home run on every trade. It's better to leave some money on the table than to turn a winner into a loser because of greed. Overconfidence and euphoria. A hot streak in trading can be intoxicating, but overconfidence after wins can set you up for disaster. When you feel euphoric from a series of profits, you might start thinking you can do no wrong. That's when traders often abandon caution. They take trades outside their plan, increase position sizes wildly, or stop analyzing the market objectively. Douglas identifies overconfidence as a common psychological pitfall for traders. The key is to stay emotionally grounded even when things are going well. Remind yourself that a few wins don't guarantee the next trade will work. Stick to the same risk management and criteria that got you those wins in the first place. In short, never let a winning streak trick you into thinking you've figured out the market completely. The market can humble anyone at any time. By keeping your confidence in check, and based on following your process, not just recent results, you avoid the trap of euphoria. Emotional intelligence for traders. The core of Douglas's message is that you must become a sort of observer of your own emotions. You can't eliminate emotions, but you can learn to recognize and control them. If you feel a surge of excitement after a big win, acknowledge it, but don't let it influence your next trade. If you're angry or frustrated after a loss, step away and cool down instead of impulsively trying to earn it back. Many top traders keep a journal of their trades and feelings, which helps them spot patterns, e.g., I tend to break my rules after 3 wins in a row, or, after a big loss, I double down to try to recover. By becoming aware of these tendencies, you can guard against them. With practice, as Douglas suggests, your mindset shifts to where wins and losses are seen objectively as just part of the game. You begin to experience trading as a neutral process of executing your plan, rather than an emotional roller coaster. Reaching this point is a strong sign that you're trading in the zone. Example. Consider a day when you've had 3 winning trades in a row. You're feeling great, maybe too great. A mediocre setup appears that doesn't really fit your plan. An overconfident trader might think, I'm on fire, I can bend the rules for this one, and jumps in, only to take a bad loss. Meanwhile, a disciplined trader acknowledges the temptation but sticks to their plan, perhaps even deciding to call it a day after hitting their profit goals. Now flip the scenario. Imagine you've had 3 losses in a row. The frustrated trader might try a huge, reckless trade to make it all back at once, often called a revenge trade. The trader in the zone, however, will remain calm, They might reduce their size, refocus on setups with the highest probability, or simply step away for a bit to avoid emotional decisions. In both cases, the trader who monitors and manages their emotions ends up protecting their account, while the emotionally reactive trader courts disaster. Conclusion. Summing up The Zone, Trading in the Zone by Mark Douglas teaches us that the real challenge in trading isn't mastering the market, it's mastering yourself. Let's recap some of the key insights. Psychology is paramount. Your mindset can make or break your success, even if your analysis skills are top-notch. Accept the risk. Embrace the possibility of loss on every trade so that fear doesn't sabotage you. Think in probabilities. No single trade is a sure thing, but a good strategy applied consistently over many trades can yield profits. Focus on process, not outcome. Judge your success by how well you followed your rules, not by one win or loss. Be disciplined and stay balanced. Use rules, like Douglas's 7 principles, to cultivate consistency, and keep emotions like greed and overconfidence in check. When you internalize these principles, you can enter the state of mind that Douglas calls the zone. In this state, you have unshakable confidence in your strategy and you aren't plagued by fear or overexuberance. You execute trades calmly and decisively, and you're at peace with whatever happens. Losses don't devastate you, and wins don't inflate your ego, they're all just part of the game. This mental and emotional equilibrium is what allows a trader to perform at their peak consistently. Final encouragement. The journey to trading in the zone is really a journey of self-mastery. It may take time to retrain your thinking and habits, but the rewards are well worth it. By adopting Mark Douglas's teachings, accepting risk, thinking in probabilities, sticking to your process, and managing your emotions, you'll be stacking the odds in your favor, not just in the markets but in your own mind. In the end, the ultimate edge is having a winning mindset. Develop that, and you'll find that consistent profits and peace of mind will follow. Good luck and happy trading!